How's it going, everybody? This is BeatTheBush. Today I'm going to talk about that little trick where you use a home equity line of credit to pay off your mortgage faster. The basic premise is this: you use the equity in your home in order to take out a loan at a pretty low rate. This low rate is typically a tiny bit higher than your 30-year fixed rate mortgage. However, people talk about using your home equity line of credit like a checking account. So as soon as you take out this credit line, you use all of it to pay into your mortgage, therefore paying it off. Now, as an example, let's say you have a 40% loan to value ratio, which means 40% of the value of your home is still in a mortgage. When they look at this, they may extend you another 40% of the value of the home, which means you can take this 40% and pay off your mortgage immediately. Now, when you take out this home equity line of credit, you're still gonna pay interest on it. You're probably gonna pay a little bit more interest than a 30-year fixed rate mortgage. The advantage here is that if you use your home equity line of credit as a checking account, you take all that money that would have been sitting in your checking or savings account and you shove it all into this home equity line of credit. So it's kind of like getting paid the interest rate in your fixed rate mortgage rather than the low percentage that you would get in a checking or a savings account. Now I'm going to do a simple interest calculation over here, and it's accurate enough for 1 year. Let's say you have a 30-year fixed rate mortgage and you have a pretty good credit score, so you have a 4% interest rate on this mortgage. A home equity line of credit is typically a variable rate plus a margin. So you're going to see something like a 5% interest rate with the same type of good credit here. Let's say your home value is about $250,000. You still have a remainder of $100,000 in your mortgage balance. You have a 4% interest rate on this, which means roughly every single year you're paying about $4,000 of interest. Let's say you walk into a bank and you ask for a home equity line of credit, and then they issue you $100,000 worth of credit line, which brings your loan to value to roughly 80% here. Now, it will only go up to 80% if you take this money and spend it elsewhere. But instead, you take this 100K and you plop it right back into your mortgage instead. Right now, they charge you a 5% APY. So every single year, you're going to end up having to pay $5,000 of interest, which is $1,000 more if you just kept all this money in your regular mortgage. The magic works here when you have cash sitting in a checking account and you put this to work for you instead by plopping it back into your home equity line of credit. So all of a sudden, now you have $80,000 in your home equity line of credit paying at 5%, which also comes out to be $4,000 in interest every year. This is the break-even point. Now, let's say you have a little bit more money, let's say $20,000 in a savings account at a high yield online savings account. Right now, you're going to get about 1.3% APY. That's not very much. Instead of leaving this in the savings account, you put all of this in the home equity line of credit instead. What happens is you have $60,000 remaining on the home equity line of credit now. You're still paying a 5% interest rate on this, but now you only have to pay $3,000 of interest into this home equity line of credit. The result is a difference of about $740 because if you left that money in your savings account, you're only going to gain about a $260 every single year in interest payments. Now, there's a danger to all this, and there's a reason why I personally have not done something like this. The home equity line of credit is based on a prime rate, which is a variable rate, and we know that in the coming years, they're going to bump this up a little bit at a time, and I estimate about maybe 0.25% every single year for the next 3 years. Depending on the home equity line of credit, it will have a whole bunch of different restrictions, such as maximum length of the loan, draw period differs, which means there's a limited amount of time at which you can take money out of it. So at some point, you can put money in, but you cannot take it out, kind of like using it as a checking account. So you have to shop for the correct kind of home equity line of credit where you can actually take money out anytime that you want. Sometimes at the end of the home equity line of credit, they might require you to make a balloon payment, which is one large sum that maybe at the end of it you may not have. Sometimes they also require a minimum balance to be taken out, but you probably won't have this issue if you take a lot of it and put it into your mortgage. There could be inactivity fees. This is also not too much of a problem if you use your home equity line of credit kind of like a checking account. Sometimes, like with any other loan, there might be a prepayment penalty. So if you suddenly decide to sell your home and then you want to pay it all off, you might have to pay a penalty on top of this. The interest payments in your home equity line of credit is deductible just like in your mortgage. So you do not have to worry about the difference of being able to deduct on one case versus another. Having a home equity line of credit could be quite dangerous for some people because you have access to, I don't know, like $40,000 on tap. That is not your money. So some people might be tempted if they get in a little bit of trouble or something, they might go and dig into their home equity line of credit. This means that if you do not have a lot of self-control, like with credit cards, you might get yourself in a lot of trouble and in even more debt than actually paying your mortgage off instead. In conclusion, you can pay a little bit less of mortgage interest by utilizing that idle money that's sitting in your checking account or savings account. There are a little bit of risk here, primarily in the adjustable rate portion of a home equity line of credit, where at some time in the future it might increase by just enough where it would kind of break even no matter if you did this trick or not. I hope you enjoyed this review of paying off your mortgage early using a home equity line of credit and my opinions on it. Don't forget to give me a like on this video, comment down below, let me know if you're already doing something like this. If you're interested in supporting my channel and helping me make more videos like this, check out my Audible link down in the video description below where you can get a free audiobook, and if you don't like this audiobook, you can cancel it before the subscription expires and you can still keep this audiobook for free and also help benefit this channel. I also have a Patreon link over here where I give perks such as help with your credit score or help with your finances. And as always, don't forget to subscribe to my channel over here and click that bell icon next to the subscribe button so that you get a new notification whenever I upload a brand new video. Thanks for watching.